can have confidence and like to keep pulling the trigger until they themselves build their own conviction. And so it's a way for me to like, again, like just like walk the walk and not just talk the talk, basically.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures. From multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. Really excited today to have someone on the show who I like and respect a lot. I've learned a lot from him, and we've worked together for a number of years, and I'm actually an investor with him as well. David's son. David, welcome to the show.
Yeah, thanks, Jack. I know it's I can't even remember how long it's been since we met, but no, it feels like we've done a lot together, and always glad to catch up and speak with you.
Absolutely. So on this show, I bash the stock market a lot. I talk a lot about wealth without Wall Street. I talk a lot about getting out of the traditional financial system. So some may be questioning, as we talk about options, but I really don't look at options as the traditional financial system. And I think you're a great person to speak on that. So if you would just tell us your story. Tell us how you got into options and your path.
Yeah, so I started out really just like any other, well, I shouldn't say that, but I was a retail trader, obviously. I didn't know a thing about options. It was when I was in grad school at Princeton in New Jersey back in 08, 09 that I had the idea to try and learn about the market. And obviously at that time, 08, 09 should ring a bell, even if you weren't in the market was going to be on your mind. So I just kind of randomly decided I took an interest in stocks. And I had a buddy at grad school that knew options. And he was like, why don't you check these out instead? Because it's kind of more interesting. And he showed me the basics of, put selling and rolling and stuff. And it was kind of interesting. And so that was how I got started. But it was really all DIY. Didn't know a delta from a theta. Those are just Greeks for those who know options. But it was around, some years later, 2017, I found Tasty Trade, or now Tasty Live. They're an online kind of options network, free education. And there was just a whole fire hose of information. And that got me to really accelerate my learning curve. And a couple years after that, I really kind of found my footing. And incidentally, I got the idea to launch my first options-based hedge fund. And so that was in 2018. And interestingly enough, knowing that your audience is kind of from the real estate background, I actually had a friend who was at the same time, because we met up for lunch, and I was like, hey, pitching him the idea that I was thinking about starting a hedge fund. And he told me he was getting into the multifamily syndication industry. And so he told me about that. And we actually ended up, I was in a business with him co-sponsoring multifamily deals. And we actually did that for a year or so. Ultimately, we did like 2 or 3 deals and I left. But interesting that was happening at the same time that I launched my hedge fund. And again, this was around 2018, 2019. Eventually, I launched a second hedge fund in 2021, and I also have a podcast that does retail option education. And the whole time I had my W-2 job. So just all of these things. So I know your audience is all about kind of alternative investments, alternative lifestyles, doing different things, being entrepreneurial. So I kind of have a little bit of all of that, and that's sort of the quick overarching trajectory.
That's great stuff. That's great stuff. And obviously, you have an education platform. It's not something we're going to teach in a less than an hour episode, but I think really high level, at least. I would like to cover kind of the difference. When someone thinks trading options, a lot of times I think they think Wall Street bets, they think aggressive, they think gambling. But as I've learned, it's not really what it is. If it's possible to distill it in a short, like how do you look at, you mentioned selling puts and selling. I know primarily I focus on selling option premium. I want to be the casino. I want to be the bank, not be the one gambling. Do you have kind of a quick elevator pitch on sort of why selling options is better? And then
Yeah,
obviously there's videos to go on from there because
yeah.
it's not a quick answer.
I'll give the quick pitch, but also with the caveat that the quick pitch is sort of like sometimes a little clickbaity and kind of meant to draw people. And you'll see a lot of stuff online that kind of pitch options as this way to get rich quick, buying or selling. But I'll kind of give the mentality when people associate options with kind of meme stock, like buying YOLO call options on like AMC or GME, that was all the hit back in like 2021, 2022. It's the idea that these are these levered instruments that you can pay some amount and you can have multiple 10x 20x profits, right? And so people are drawn in by these promise of like big wins, but these are low probability types of trades. So it's basically like buying lotto tickets. So you're a lot of time your money just going to go to zero. And so people who don't understand how options work and just see these as a way to get leverage, a lot of the statistics say that a lot of people really don't make any money or make anything, honestly. But really in options, uh, it's just an instrument. It's a derivative. I would say think of it as sort of like uh, if you think about your insurance, your home insurance or your car insurance, those have optionality. Those are options. When an event happens, right? They're a transfer of risk, right? If you're have a car accident, you have the option of getting a payout, right? That's to offset your risk. And there's a certain expiration date, which is sort of the policy date, or your option on your home. If the house burns down, there's an option, you get the option to get a payout, right? But if you think about from the other side, somebody has to issue that option, right? And the insurance companies issue the option, and yes, in an event that the risk happens, they pay out, but to compensate, they're collecting what premiums, right? So the insurance companies make premium and they collect that, from all the people who buy the insurance or the people who buy options. And they kind of model it out where they know that there's a statistical chance of certain events happening. They'll have a payout. They're insuring 1,000 homes and 2 of them burn down. Yes, there's a big payout, but at the end of the day, it's all baked in. They're going to have some profit margin, net of, whatever they have to pay out. Similarly with options, these again are these kind of transfer of risk instruments, and you're kind of insuring against kind of market risk, right? There's options that pay out if the market goes up. There's options that pay out if the market goes down. And as a seller of these options, and to be clear, and this is where the caveat comes in, you can't just sell options willy-nilly and expect that you're going to keep all that premium. That's where people kind of get it wrong. They think there's these options you can sell with 95% probability of success, 98% probability of success. But if there's 95 and 98, there's still that 2% chance, 5% chance you lose. And people who size too big, right, you get hit with that big loss, right? So there's this sort of analogy people use, the idea of picking up pennies in front of a steamroller, which it's okay to pick up the pennies as long as you don't get steamrolled, right? You have to know how to manage risk, how to move, how to get out of the way if the market's moving against you. But again, high level, you mentioned the idea of being the casino, right? There's some edge there, or being an insurance company, you're collecting these premiums, and there is, as long as you manage the risk, you're collecting these premiums day in and day out. Occasionally you have to pay out. That's sort of like, the house burns down or the car crashes. But there is a model there, and you can't model a business around generating some kind of income as a seller of options.
David, that was a really good explanation, and I think really sets the stage for things. And neither of us, you mentioned you have a W-2 job. You did go to Princeton. I only went to Rochester Institute of Technology. So I want to make it clear here that there's a lot of people that make a living trading options that are not. You don't need to be an Ivy League grad, or you don't need to be a quant, and it doesn't need to take up your entire day. Just to give people perspective on my options journey, I found some YouTube videos in probably 2016. It was sometime between Christmas and New Year, and I went down a YouTube rabbit hole and watched 20, 30 hours of videos. And then, was testing some things myself and on some various forums. And that's where I discovered you in 2020. So it was a couple year path of just trying a couple things out, trading very small, just a few $100s here and there, really to learn the mechanics and figure out what works. And then after connecting with you and finding a few strategies on these forums, I actually found a couple strategies that became really solid long-term winners for me. So, and it's not something I spend hours a day doing. It's sometimes, a half hour here. Sometimes it's positions that are on for 30 days and I monitor them just like I monitor, any other stock. So we talked a little bit about this before the show, but I think it's going to be very helpful for the audience to just talk through the different options to invest in options where it doesn't have to become a full-time job. You don't have to watch the charts all day. Can you speak a little bit about that?
Yeah, I think there's a couple things to touch on. One is options aren't quote unquote easy, right? There is always some education that you have to go through, but that's like anything, right? Even with real estate, there's a learning curve. And I know sometimes there's a lot of these, again, like you found videos on YouTube, and it's hard to parse out, who's telling the truth and who's just kind of doing some fluff to try to get clicks or trying to sell a service. And so once you get past the kind of learning about some basics, and as you mentioned, you don't have to have an Ivy League degree. I always say, like, if you can do simple algebra or just some basic arithmetic, I think you could. Because for me, trading options is once you learn about how options work, that's one thing. But executing strategies, I always look at things like, okay, if you can calculate a win rate, a loss rate, then you kind of average out your size of your wins. Like, let's say I lose $200 when I lose and I win $100 when I win. I mean, just basic numbers, and you can multiply out very basic probabilities and kind of set up like what's called expectancy, which is just kind of multiplying those things together. And at the end of the day, it's like more about being meticulous of like when you put on trades, and you log them and you kind of study the statistics of like how each one pans out, you start to see patterns. And as you mentioned, the way we trade options, it's not about, people think about like day traders who are always in front of the screen looking for a setup, or they're looking at different indicators and looking for like a crossover of a moving average, and these are just different jargony things, but they're looking for like opportunities to place trades, and just monitoring and looking for these positions takes time, right? And so people who get this impression that to be super successful, you have to have all, it's almost like another full-time job, right? And that's just not going to that's not going to work with certain people's schedules, right? And so the way we approach is, as you mentioned, depending on the type of options and type of strategies, there's certain ones where you're just monitoring, once a day, twice a day, just like you're monitoring stock if you need to make an adjustment. And there's certain strategies where once you put a position on, you already know where you're going to exit, right? It's called a profit take or a stop loss. Basically, you're going to close out once you've hit a certain profit, or you're going to exit at a certain loss. And these are things you predetermine because you kind of have a strategy that lays out the rules. And so once you put on a trade, you put on an exit, you don't necessarily have to be there. It's going to execute when the conditions are met. And so, again, with the right types of strategies, and a lot of it comes down to kind of conviction and understanding, because if you kind of just jump into something, as soon as something goes wrong, you're going to get worried, or you're not going to follow the rules, or you're going to kind of change things up and kind of not follow the plan. But once you mentioned you learn about it, start small, sort of like a starter size, or you're kind of just trading to get a feel for how things go. Eventually, you get to the size that you're comfortable trading, and it kind of becomes a routine. Again, like, I put on a certain number of trades in the beginning of the day, set my exits. I have some trades I might put on towards the end of the day. But again, it doesn't have to be about constant monitoring. You might honestly, I spend more time kind of detailing, journaling, and logging the trades that close than necessarily actually putting on the trades. So for me, I think I want to set that out there, that there is a possibility of kind of being active in your investments and trading, but that doesn't equate to a full-time job necessarily.
That's very, very well said. And I know from my perspective, I have a strategy that I've been doing pretty consistently since 2020. And, I basically took it from the discussions on the forums. There was a lot of people getting together that are way smarter than me, that were doing, doing a thing called backtesting to look, say, what would happen if you did the strategy in this way every day since 2012, as an example. And, the statistics show that the strategy is profitable across the market cycles. But I don't, as someone who's been doing something for a number of years, I didn't have to actually do all that work. There's tons of information on the back testing out there. And I think that's probably, considering I still don't know how to do it, it's probably still way too detailed to explain fully on this episode. But I think maybe is there a way, can you in a really high level just kind of, because I know you've done some back testing yourself, like how does someone or where do you get information like that to, if you think of a strategy to decide if it might, and again, past results don't predict the future, but if you go through a 10-year cycle, I think it gives you a fair amount of information on maybe what could happen with the strategy.
Yeah, if you had asked me this question even 1 or 2 years ago, the answer would have been very different, because that was the difficulty. And I mentioned conviction helps with the execution, but you can't get conviction without knowing the context, which is the backtesting. And back then you had to buy your own data. You had to know how to program. You have to know how to work with large volumes of data and then build your own test engine and interpret the results. Now there's basically off-the-shelf softwares that are available, and you can link them in the show notes or whatever. There's one called Option Omega that has been very popular in the last couple of years. I work a lot with them. I actually consulted on some of the parameters they output. But these are, I don't want to oversimplify things, but literally they give you the ability to just say, hey, if I traded this option at this time, took profits here, and like you said, what would that look like throughout the last, and they go back to 2013, for example. You can look at different years. And the cool thing is, as soon as you see the result, you can tune the parameters. You can, okay, what if I, instead of taking 50% profit, I took 60% profit or 70% profit? And you can save all of the different runs and do comparisons. So it's really, there's very robust tools available at the retail level. And, you just mentioned a comment of like, you don't even know how to do this yet. But I think if you got into the software, for example, and took an interest, you could just really kind of get into it. And having tools like that, I think, for me, I feel like the last few years and moving forward is kind of a good time as a retail investor, because there's products like that available, and there's just kind of more data and knowledge available that even a couple of years ago weren't available.
That's great. That's great to know. Yeah, it was always one of those things where I knew it was out there, but yeah, I still had the impression it was still a lot more complicated. I wasn't even aware of. It was called Option Omega.
Yes, that's right.
Cool. Well, let's try to get a little simpler again, just to make sure we're because I think a lot of our audience is really new to this. Like, let's talk about maybe 1 or 2 really beginner strategies. Say somebody who has a pretty, a sizable account, and they're holding index funds, Vanguards, a Tesla stock. Somebody's got $500,000 in their account, but they want to start, learning options. Like, let's maybe talk through 1 or 2 really simple, relatively towards the safer end of strategies of where somebody could start.
Yeah, and I'll mention one strategy that I teach on my podcast and kind of show results on my trading page, for instance. And to kind of contrast a bit, because you mentioned large account, and it's funny you mentioned they might have some index funds or whatever. And right now, like the traditional advice is to be passive and buy and hold, right? But it's not terrible, but it depends on your time frame. Like if you buy an S&P 500 fund and hold it, and depending on the number of years and which time frame, right, people expect 6, 8, 9, 10% return annual, right? But again, that's very specific to what time period you're looking at. And of course, as you know, with periods like 2008, 2020, 2022, there can be large drawdowns and large losses. And this is why people traditionally like are scared of the stock market, or say like this is why they don't want to invest. But if you want exposure to the stock market, to that S&P, for instance, rather than buying the stock, right, and a simple strategy with options. So let me break it down real quick. We mentioned earlier, options are sort of like a transfer of risk instrument. It's like your insurance, for your home or your house or whatever. So there's something called a put option, which basically is like an insurance policy to the downside. If you buy a put option, you're paying some premium, and it gives you the right to sell stock at a fixed price. So let's say that I'm just going to use an arbitrary number. The market is trading at 4,000 and you want to protect your stock. You buy a put option at 3,600 or some percent down. And basically, if the market crashes, you have the right to sell the stock at that price, regardless of how far the market goes. And that's kind of like that insurance payout. But if you turn it around, you can sell that same option and collect that premium, and you can sell it 5% below the market, 10% below the market, and you're sort of taking a bet that, hey, I don't think the market's going to fall this far. I'm going to be the insurer, and I'm going to collect that premium. And you collect these premiums, and you can essentially, that's called selling a put or writing. They actually use the term write a put option, almost like writing an insurance policy, right? Because you're collecting that premium up front. Now, the issue is with people who kind of aren't aware of the risk, and they assume, oh, I don't think the market's going to fall 10% or fall 5% within that next month or 3 months, whatever, how long you write that option for. And so this is where the difference for me, and I have a big focus on risk management, and I'll say, hey, if the market moves against me and I'm starting to take losses, and the way the kind of the profit and the losses work is, let's say I collected like, I don't know, $1,000 of premium. If everything goes well, the market stays and behaves, that option is just going to expire because the market never crashed, and I keep that entire $1,000 of premium. That's my profit. But if in the interim the market starts to crash or starts to go down and gets close to that price that you set that floor on, the way the losses work is it's almost like the risk is increasing, so the price of that option will increase. And I know the math is a little backwards, but just think about it this way. If I sold something for $1,000, I collected $1,000 of cash, and that thing is now worth $2,000, and let's say I get scared, I want to close out. I don't want to be obligated to pay out if the market crashes. I now have to pay $2,000 to, they call it buy back or close the position. So it's just simple math. If I sold it for $1,000 and I bought $2,000, I'm down $1,000, right? I'm net down $1,000. And so what I just explained is basically what's called a stop loss. If the losses go to a certain point and I don't want to take that unbounded risk, I will close out. And so that's the main difference. And in that case, it's true, you've realized the loss. And a lot of people kind of grapple with this, especially new traders. They believe, oh, this is a 95% trade, 99% trade. And they don't want to lock in that loss, especially if they feel like, oh, the market might actually rebound. And kind of, they call it like hopium, right? Like hope is not a strategy, And so the difference is, for me, a simple strategy would be, okay, I'm going to sell these put options at a fixed interval, daily, weekly, monthly, whatever it is. And I'm constantly collecting these premiums. But occasionally I will have to lock in a loss. And so, and this touches upon what I said earlier about like the kind of the probability. So if I sell this option and I collect $1,000, 10 times, I have $10,000 in the bank. But sometimes, let's say I have to pay out $2,000 2 times, right? So I paid out $4,000. I'm still up $6,000, right? And so it's not always going to be perfect. Okay, every 8 you're going to lose one. Every 5 you're going to lose one. They kind of come in clusters sometimes. So that's where kind of the belief in the statistics and the math comes in. It's not like nice and perfect. Okay, every single month I've collected this, I paid out this. Long term it is. On a short-term basis, weekly, monthly, it may not be so perfect, but that's the high principle of like what a strategy of selling options. You sell the premium and you have some amount you're willing to cut the loss for. That's called a stop loss, and you have to that's your way to manage the risk. So that's why if you're selling options and the market does, the next COVID happens, you're not wiped out and lose. You don't want to sell $1,000 of premium and be on the hook for 100,000 or 50,000, right? That's what we call like a black swan or like a multiple, right? The loss is much greater than the potential gain.
Great way to put it. I just want to add, it reminded me a bit about the wheel strategy. And let's say if you are trading small and you were going to own 100 shares of SPY anyway, which is a little over $400 a share right now. So let's say you were going to own $40,000 worth of S&P, the SPY anyway, but you think the market's a little overvalued because we just had a little run up. You could actually sell a put at 380, and in that same scenario, it's if it stays at 400, it expires worthless. You've collected some premium, but if it drops to 379, you have to then buy those 100 shares at 380. So in some cases, if you're, and I'm not advocating timing the market, but if you're doing it small enough and you actually have the money to buy the stock, buy 100 shares of the stock anyway, it could also be a way to back into positions that are cheaper than if you just bought the 100 shares of the stock. Now, you may miss a little upside if you do that for the entire year, but you'll still, if you look at what the dividend would be on S&P, it's, I think that dividend's 2 or 3%. And, if you're only expecting 8 to 10% annual return anyway, you can, on an up market, you're generally making that or more. And in a down market, if you are going to take assignment of the shares, you're at least buying them at a, during a pullback. Now, a black swan is going to be a black swan, but you would have lost money either way in that scenario, right?
Yeah, I think what's interesting to point out and to kind of differentiate what you just said and the kind of strategies, I like to use is it always comes down to your own expectations and what your goal is. Like if your goal is in fact to buy the shares and, you want to collect a little premium up front and then possibly get assigned, and like I said, you have the cash. So if that fits within your plan and your own objectives, then that's fine, right? But then, and so my preference is I'm using, the way I see options is more as a vehicle to gain exposure to the stock, as in the risk exposure and the premium. I personally may never have any inclination or want to own the shares. I'm only just because I'm trading options on the SPY doesn't mean I want to buy SPY. I just using options because there's a premium there to collect and I want to manage my risk, and it just happens that SPY is, they call it the underlying vehicle that the options prices are based on. So it all kind of comes down to like what you're trying to get out of it and what your objectives are, short, medium, long term, for instance.
Yeah, very, very well said. And I tend to go more towards your route. I'm using stop losses. I'm trading, more options contracts than I would want to take assignment to hold longer term.
Exactly. Yeah. If you're leveraged, you can't take the shares. So in that case, it's very dangerous to hold and hope that the market reverses, because if you get assigned, you're gonna go on what's called margin because you don't have enough cash, so you have to borrow cash. So you can get a lot of trouble very quickly that way.
Yeah, and even to that point, I actually use a symbol called SPX that does not get assigned. It's cash settled, so it takes away the chance of assignment and or the option of being assigned. It's not even a possibility.
Right.
So that's yeah. When you mentioned the math, it really reminded me too. It's I know a lot of people who were not valedictorians of their school, but they're hell of a poker player, and it reminds me a lot of Texas Hold'em when you have these basic probabilities of you have a flush draw and there's this much money in the pot and there's this much money to potentially make, and the math is, like, for the most part, that simple, at least to me.
Yeah, you have to be good at decision making, but the decisions have to be based on something, right? And like you said, you don't need to know calculus, but I think at least basic algebra and some, like basic probabilities. I honestly think that's enough, but know those very well because you're going to apply that over and over again. Trading over the long term is really just doing the same thing over and over again.
Exactly. I feel like we should touch on some of the market volatility as well, for those that understand kind of how the option pricing adapts when things happen. Can you kind of touch on, last year obviously was a down year for the market. What did you see over the course of the year for sort of the premiums and how they changed, or how far away you were from, say, the actual stock price at a moment from beginning of the year when things were still on an upswing and everybody was seemingly optimistic, and then when interest rates start moving, the whole market sort of went haywire?
Yeah, so you've probably heard people say the stock market is forward looking, or it's sort of like what the market thinks things are going to happen, 6 to 9 months down the road or whatever. With options pricing, there's a term called implied volatility. It's similar. It's basically what the market thinks the level of volatility will be in the next, and it could be 30 days out, 60 days out, 90 days out, just depending on how far out the options is. So that's called implied volatility. And what the market actually does, that's called realized volatility. So if the market thinks we're going to go up and down X%, right? That's the implied volatility. But then in hindsight, if the market really only moved, that could be more than the market thought. It could be less. And whether or not the market moves more or less than what the market predicted, that will drive profits. And I'll use an analogy just to kind of bring it back to insurance. If you're an insurer of homes and you're in an area where it's like, or let's say you're doing flood insurance, right? So you're in like a desert, right? You obviously don't expect a lot of rain and flooding, so you're not going to charge a lot for the premium, right? So your implied volatility is low, and most of the time the realized volatility is low. But if there's like an outlier and one day some kind of freak of nature or climate change, and then there's like a once in a decade or once in a century flood, right? That's called high realized volatility because you don't expect a flood in a desert, but something unexpected happened. And so in those cases, those are the years where the insurance people will kind of take a loss because they only collected premium to offset the risk of, not a lot of rain, but all of a sudden a lot of rain comes. And so the same thing happens. And I feel like after one interesting note is 2008, volatility was sky high, a lot of premiums, a lot of people made a lot of money after the fact because after that decade, the market sort of has a sticky memory and they think that risk is going to happen, but then nothing really did. So premiums were high. So if you're a seller of premium, you made a lot of money for a number of years. And as more years went on, where no more crashes happened, the market starts going, oh, maybe things aren't as bad as we think, right? So their expectation of volatility goes down, the premium goes down, the implied volatilities go down, and so it keeps compressing, and until we all know what the next kind of event was in 2020. So right before 2020, the VIX, which is the indicator that kind of tracks what the market perceives the volatility will be, it was at its lowest for a number, it was at like 13 or 12 or something. And then when COVID happened, it exploded. And so you get these kind of cycles where something crazy happens, everybody freaks out, implied volatility goes up, and you can start making a lot of money selling options. And then some number of years go by, and you can almost think like, we know that things go in cycles. Human psychology and human behavior follows. They have like short memory, right? So they can only remember, or they react on what happened in the last year or the last 2 years, and so that's why things repeat. Although recently, I think the cycle kind of happened more quickly because after COVID, everything went well. We had the 2021 bull market, so it was like 2 years of compression of the volatility. And then 2022 happened. We had that surprise with the rate spike. So then everything went crazy again. And now we're seeing this year, we finally saw a little bit of volatility like in August, but it was really brief. But I feel like it's been kind of compressing. And now VIX yesterday it was once again at 13, which is basically the lows you hadn't seen since pre-COVID.
Yeah, and that's really all set by the market makers. Just to be clear, if you're trying to get into options, it's not like you need to figure out how to set the price. It's in that way, it's a pretty efficient market. You could pull up the chain, and it's really how far away from the strike price. If if S&P is at 400 and you want to do a 30/70, you'll get a certain amount of pennies or dollars per contract. The closer you are to the money, the more per contract you receive.
Right.
However, when the volatility is very high, you might be 100 points away or 200 points away and still be able to collect real premium. Whereas in a market, like today's market, if you're that far away, there's either no bid, or you might get 5 cents or something where it's not worth selling. Did I say that right?
Right. Like we were saying, we don't want to scare people and think you have to figure out these pricings. But what's going to happen is, so the price is the price. But the reason I was explaining the context about realized versus implied volatility. Implied volatility is the price you see. Realized volatility is like what the market actually did. So what's going to happen is if you have some kind of systematic strategy where you're selling premium at a fixed interval, your profitability will be more on the times where the market is less volatile than the pricing suggests. Like, so if you're again, if you're that insurer of, selling flood insurance, you'll make more money in the desert versus selling insurance in a floodplain, right? So you just don't know at any given time because we can't, unless you can predict the future, which I can't. But if you're the seller of that flood insurance, you'll make more money during dry season and you'll make less money during rainy season. Does that make sense? Just to kind of use an analogy to tie the realized versus the implied volatility.
Yeah, absolutely. And it reminds me of a rule of thumb that I think works across pretty much real estate, the stock market, almost any investing, is the dollar cost averaging. You want to be consistently investing, and you might lose on a few positions when you have those crazy 2020 crashes, but if you're trading with a relatively, no more than a certain amount of your overall portfolio into any one account, under any one position, yeah, you're going to take a little bit of losses in February, March of 2020, but then for the rest of that year, you're going to, print money because volatility is so high. So it's important to just keep dollar cost averaging in. And that's to me, one of the golden rules of investing is that dollar cost averaging, historically has worked. Even 1929, if you put all your money in the day before the 1929 crash, you're going to lose, it would have taken you 12 years to break even. Right. But if you put in equal intervals 6 months before and 6 months after, you'd be positive in a year and a half.
Right. For sure.
Yeah. So one of the, when we connected, one of my favorite parts about, really what drew me to you is you were posting real trades, real results on strategies. And I saw what was working, and I saw what had some challenges, especially, through 2020. And that was super, super helpful for me. Are you still, you mentioned you have your trade busters. I know you have a blog, you have a Discord, you have a couple things. What type of content is out there?
Yeah. So, I think you and I on the Facebook group, maybe. There's so many places I've met different people. And back then, people would just post trades randomly, and you get that phenomenon of, people only posted winners, or they never posted losers, for instance. But I wanted to be accountable and kind of post consistently. So I started off posting my trades in Facebook. But then I was doing it so consistently, and I wanted a place to track everything. I made a trade log and just put on Google Sheets and just kept that as a publicly available log. And that's how my quote unquote trading page started. So it's not an actual web page per se. Like, I have a domain, but it just redirects to the Google Sheets. And so over time, I added more strategies, and I still post there. And I also, I was writing like short essays about different trading topics, but then I got tired of writing, so I started my podcast. My podcast is just because I'm lazy about writing, and I'd rather just like now we can jam out for 30 minutes to an hour. It's just a lot easier for me to speak. And so the podcast was sort of an extension of things I wanted to share. Eventually that branched out to having guests on different topics. But to your original question, I feel like now the trade log is a way for me to kind of lead by example, because to bring it back to what I said about, even if you have a strategy and a plan, when things go wrong, if you don't have conviction to follow through, you're going to fall off the rails. You're going to change them. You're going to quit. You're going to do whatever, especially with even the put writing strategy I mentioned in 2022. That particular strategy lost money, right? The market's down. You can't expect selling puts makes money when the market goes up. So when the market goes down, you're not going to make money, but that's fine. It does not mean the strategy is not working. The strategy is doing what exactly it's supposed to do, but it's based on what the market does, right? That one strategy. So I feel like by leading by example and by doing it and kind of like, putting my money where my mouth is, it's like people hopefully can have confidence and like to keep pulling the trigger until they themselves build their own conviction. And so it's a way for me to like, again, like just like walk the walk and not just talk the talk, basically.
That's great. And that's definitely what drew me to you, and really, fortunate that we connected, because, the one strategy which we didn't really go into here, and it's a different episode completely. But the strategy that we worked on, I've been using successfully since 2020. Had really good run in 2020 and a really good run beginning of this year. But yeah, there was periods of time where it was flat or slightly down. I had a down month in August. It was my first losing month of the year so far, but August was kind of a rough month with lots of ups and downs.
Now,
and so
imagine if you'd started that strategy in August, for instance, right? That's the thing. A lot of people, their success sometimes is just randomly tied to when they start, right? So if somebody saw what I was doing, saw what you're doing, decided to try it out themselves and didn't have any guidance or someone to talk to, run in August, okay, they think it doesn't work, quit, move on, and they'll never see that something like that can work. So I think having people to talk to, someone to look up to, something to follow as an example, that plays a big role in long-term success.
Absolutely. Really, really well said. And, with that said, let's make sure everyone knows how to get a hold of you. So, please list off, all of your platforms, social media, wherever everyone can find information about you.
Yeah, so the podcast is called The Trade Busters with an S, it's plural. It should be on most platforms, Spotify, Google Podcasts, Apple Podcasts. The trading page is thetradebusters.com. And again, don't be shocked if it goes to some janky looking Excel looking like thing. That's intentional. It's a kind of running joke that I was supposed to make it into a real website, but it just never did. And then if you want to follow me on Twitter or X, it's at the Trade Buster without the S.
That's great, and we'll put that all into the show notes as well. So. David, really awesome to connect and chat with you as always. Really great information, and thanks for coming on the show.
Yeah, good catching up, and thanks for the opportunity to share.
Great. All right, everyone. Thanks. We'll see you in the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.